Happy Wednesday, everybody. It is hump day, and we're coming at you with the mortgage update. How you doing, Matt?
I'm over here like, holy shit, it's Wednesday.
It's Wednesday already. Yes. You got a nice little 5 o'clock shadow going.
It is going pretty good. It's 1 o'clock though, but it's growing fast, man. you ever see those Mexican candies where you like push the bottom and
it comes up
top?
Yeah.
I feel like that's what my beard is. All this pressure.
It's like that with my nails. For some odd reason, I feel like I just cut these damn things yesterday and they're already grown.
You're like,
Yeah. I was telling Kristen the other day, maybe they can run like a scientific study on me where they can extract some of my calcium or something and then sell it, and we can make a bunch of money because my nails grow fast.
I'm going to start donating my hair.
Oh, welcome everybody. Come on in. We're going to go over interest rates. We're going to, we were going to talk about credit, but we'll leave that for another conversation because there were some other topics that came to the table, brought to us by a couple of DMs. Huh? We'll call it that.
Oh.
So let's get into our rates of the day. All right, Matt, take it away.
All right. National average. We're looking at 30-year fixed conventional 7.01. So it's actually, these are based off of what? Is that today's rates?
That is.
Yes, these are today's rates.
Yeah, they sure are.
All right, because I'm like, we were not at a 7.1. So we're at today's rate, 7.01 national average, which is actually better by 0.02%.
Mm-hmm.
We're looking at 15-year fix at a 6.46%, and that is also better by 0.02%. You will go down to our FHA 30-year fixed, along with your VA. Your FHA is at a 6.50%, which is better by 0.02% as well. So you're kind of seeing that carry on across the board here. VA is better by 0.01% at a 6.54% rate national average based off today's rates.
Based off of today. And they are average, national average. There's no particular credit score that they give. So we have to assume that they're also using an average credit score based on the nation. And Matt just recently found out that I believe it is
a 694. So if you're looking at this on a national average, this is almost based off a 700 credit score.
Almost.
So if you're here in Texas, the average credit score that I was looking up was a 664.
Yeah.
And then it actually gets worse when you get to San Antonio.
When you get to San Antonio, yeah. Yeah. And we're going to plan a pretty good little credit seminar episode where we take you through the do's and don'ts, some tips, some tricks, even how to get some of the things that are on your credit off of your credit. So stay tuned for that. Maybe we'll do it on Friday.
And in the meantime, pay your bills.
Pay your bills on time. What is that? We don't want no scrubs. All right, so let's jump into the first. I think it's a video. JC, if you'd pull that up. Housing will see a slow and bumpy return to normalcy, says Black Knight's Andy Walden. Let's play that.
Andy, welcome. What's your take on the latest round of data here?
Yeah, I mean, I think you covered it really well there. I mean, we absolutely saw some demand return to the market early this year when we saw rates get down closer to 6%. Very welcome news for lenders and transactional-based folks out there in the market. And it did show that underlying demand that still sits there if and when rates come down. But at the same time, sellers are backing away from the market. And so we still have these massive inventory deficits out there, and that's resulting in price hardening this spring.
What's going to happen in kind of the spring selling season? Then it originally looked like we could be off to a good start, an early start. And what now?
Yeah, I mean, you're right? So we saw demand return early, the later months in February. So we went from a 30% deficit down to a 15% deficit. We're back to a 25% deficit in terms of demand. I think what we'll see is a modest rise in transaction volumes. We're already seeing that in our collateral analytics data for the month of February. And so we're probably nearing the bottom there in terms of just overall sales volume and purchase origination volumes out there in the market. But it's going to be a slow and kind of bumpy return to normalcy. And unfortunately, I mean, for folks wanting to see prices remain high, the data is good for them right now. You're seeing kind of this stalemate out there in the market, not a return to balance, but we're not seeing anybody budge here. So low transaction volumes, hardening home prices is kind of how we see this playing out over the next few months.
It's almost like the Bitcoinization of the housing market. You know, there's only 21
like
million
the Bitcoin
that we're ever going to have, and everyone went and snapped one up, and everyone's just holding on to them. I mean, I don't know how you get more image. So in a market where if we go back to 2006, when prices started to drop, we overbuilt, we saw people then immediately back away. What's it going to take to get prices to turn in this market?
Yeah, and what's noticeably different about 06 through 2012 was the Fed dropped interest rates to try to catch the market there. And so you didn't see this lock-in effect that we're seeing take place now.
True.
The other thing that took place there was we had this massive wave of default activity. We had 25% of homes were mortgaged with adjustable rate loans. So they were much more volatile, and you had interest rate sensitivity, and folks were willing to sell because their rates were resetting anyway. We're running at some of the lowest levels of outstanding ARM loans we've seen in the U.S. in over 20 years. And so default activity remains extremely low. Foreclosure sales, 70% below pre-pandemic levels. New builds are very low. Existing home sellers are selling their homes at a 27% lower rate in February than they traditionally do. So every potential possibility that we have for increased supply is running well below normal levels. And there's no line of sight into how that returns. The demand side there absolutely is, right? And we're seeing that in terms of when rates fall, you're seeing that demand return. But that same lever that's pushing on demand is also holding supply tight, and there's less of a line of sight in terms of how that supply side returns.
You did just give me one idea about how this, when this will all play out, which is to say when the 10-year starts dropping. So in other words, if you look at the market now, we have people pricing in pretty extreme rate cuts kind of next year. It's like the more hawkish Powell gets, the more the near term goes up and the long term rates decline. If we get into a situation next year, Andy, where all of a sudden the 10 years down 1.5 points, we're back at 2.5%, and people feel like, oh, I can move because now my new mortgage will be affordable, and I'm going to list my house now because I'm worried that prices will fall more, then I wonder if we wait a year or so out, if it's going to be a very different story.
It could be, right? And what you tend to see is the 30-year tries to project where the 10-year and where the Fed is going. And so in past rate cycles, 30-year rates peak 0 to 3 months before the 10-year before the Fed does. And so we could see, absolutely to your point, you could see 30-year rates and mortgage rates start to ease before the Fed starts to let off the brakes. Though the question is, will that move the needle for sellers? It absolutely has. And you can track demand right along with interest rates. But even when interest rates eased in January, early February, we didn't see a return of sellers to the market. And that's really where my concern is it hasn't ebbed and flowed directly with interest rates. And so there's no guarantee that sellers are willing to sell at a 5.5 or a 5% interest rate.
Oh, sure.
We'll have to see how that plays out.
Yeah, I have to agree with a lot of the things that he said. There was no emotion attached to it. It was all factual, data-based. Oh.
All right.
So I think that he's got a pretty good grasp on what's going on. The lady might be in denial, or maybe she's just trying to bring up good points and talking points. But the idea behind sellers being locked in their home, well, it's pretty true.
I mean, it's kind of hand in hand what we've been discussing over the last couple of weeks too. I mean, she tried to mention like, hey, maybe it's one of those where we wait till next year and a half, which we said, rates are set to increase over this whole next year, which I mean, who's going to sell their property that they have a 2-3%, 4%?
Highly unlikely.
Very, very.
Yeah.
So, I mean, it just goes hand in hand with what we've been talking about.
And that goes with the values of properties and them possibly decreasing. I just don't see that. When you have a limited amount of supply that we continue to have because no one is bringing their properties to the market unless they have to, I just don't see any holes in that story. I mean, I don't see any possibility for a whole bunch of properties coming to the market. And then you've got the idea behind, well, what if there's a whole bunch of foreclosures? There's got to be a bunch of foreclosures coming. Well, that kind of goes with this next video that we have here. Let's throw that one up and see what they have to say about Business Report waves of foreclosure default fear.
This editor Richard Southern is here now. And Richard, with interest rates climbing, many homeowners have been turning to riskier sources to borrow money, and that could spell trouble.
Sure could, Erica. Good to see you. It's private mortgages that are on the rise quite dramatically, both here in Ontario and Canada-wide. Of course, mortgage rates have gone straight up over the past year, and that's made mortgages harder to get for a lot of people from the traditional banks, and so they're looking elsewhere. We're finding out here that just in Ontario, private mortgages surged 72% from 2019 to 2021. And that means more than 10% of new mortgages were private. And that number likely continued to surge in 2022 after
Stop it right
the
there
Bank
real
of Canada
quick.
hiked interest rates.
Okay, so they surged from 2019 to 2021. That was amidst the pandemic. So that
and then the rates decreasing into 2022 and starting to go up.
Okay. Yeah, I mean, it just, I don't know. Keep going.
Making those mortgages harder to come by from banks. You know, the private lenders, they don't subject mortgage buyers to stress tests, whereas the banks have to. The banks have to make sure buyers can afford a mortgage a mortgage rate that's 2% above the current rate. You don't have to do that with the private lenders. And so the concern is, as mortgages become more expensive, that this could trigger a wave of defaults. Just one other thing to worry about, Erica, in that tricky housing market right now.
Pause that right there.
You just talked about
and come to us.
Do you think that the increase wasn't because it was a person per se, but it was more so investors saturating the market, making these purchases with a private mortgage or
correct.
Having their hard money lender, what have you, and they're expecting a default, but these people are investors that are flipping these properties that are probably already made their return.
And I have to agree 100% with that. I mean, the idea behind their going to be default. No, number one, let's backtrack. If you are a buyer out there, why would you go to a private lender unless you don't qualify? Now, the qualifications don't change because the interest rate changes. Even private lenders, hard money lenders, ask for more money down. They may ask for a logical approach to how you qualify, bank statements, things of that nature. But the idea behind them being easier to obtain doesn't make sense. They're even higher in interest rate. So I'm not seeing the correlation between the two. Obviously, they're talking about Canada, so it doesn't coincide with United States, But there is one more article that I brought that I want to talk about, and it is data-based. So if we could fly over to that real quick. Here we go. It says the U.S. foreclosure activity declines monthly in February 2023, but continues to increase annually. That in itself is a tactic. Just the title itself. I mean, we're decreasing, but year over year, it's increasing. Well, the previous year we were in a mortgage, what is the word? Moratorium, something like that, to where you could not foreclose on anybody.
Yeah, it was impossible.
Correct. So you're going to see a year over year difference, but the month over month difference, that's really what we're honing in on to see what the heck is actually happening. So let me dive into this real quick. It says, Irvine, California, March 8th, which is today, ATTOM, a leading curator of land, property, and real estate data, today released its February 2023 U.S. foreclosure market report, which shows there were a total of 30,528 U.S. properties which foreclosed filings, default notices, scheduled auctions, or bank repossessions, down 3% from a month ago and 18% from a year ago. The year ago part is totally irrelevant to what we're talking about here.
I think if you take anything into consideration when you're looking at any data, I think if you just erase the last year and a half, it'll be a lot easier just because we had the pandemic. You couldn't foreclose. Rates were super low. It's just like the stacks on stacks of things.
That's so true. Let me finish this off. Foreclosure activity finally started to stabilize in February after 21 straight months of increases, said Rob Barber, Chief Executive Officer at ATTOM. The numbers don't yet show a clear trend towards fewer foreclosures, partly because the February is short month. Okay, we know that, but with historically high levels of home equity flowing from a decade of rising values, we may be seeing a growing number of delinquent mortgages payers with at least the only option to sell before facing foreclosure. Well, if they sell, they've got equity. Smart move if that is the case. If you can't pay your mortgage, sell it. By all means, you're going to net some equity. And therefore, if you lost your job, you at least have a nest egg. If you didn't lose your job, then go take that equity and buy another one. It's not like you're going to be buying it at a discount, because chances are you're not going to need to sell your home at a discount either. But I guess you never know. It says lenders repossessed 3,831. So 3,831 U.S. properties through completed foreclosure REOs in February 2023, dipping 2% from the last month, but increasing 45% from the last year. Again, not relevant, the last part of that. The part that I see as a pretty cool indicator is 2% decrease from the prior month, where it was supposed to be increasing because interest rates and all of these arms are coming due and all the fear that they're continuing to push, thinking that you're going to not go in the market to buy. It continues and says states that had at least 100 or more REO and saw the greatest annual increase in completed foreclosures in February 2023 include New York, we know that, Georgia, California, Texas up 87%, and Virginia up 73%. I'm curious to dig deeper into the Texas one because all you have to do to have 87% increase is have zero the month before.
Like, oh, wow.
Yeah.
How many foreclosures do you have last year?
Right. And it says at least 100. At least that number doesn't say at least 1,000, at least 10,000 foreclosures. I'm not seeing what we had in 2008. Those major metropolitan statistical areas, MSA, with a population greater than 200,000 that saw a greater number of completed foreclosures in February 2023 included Chicago, New York, Detroit, Philadelphia, and St. Louis. Foreclosures starts decreases monthly in 25 states, including the District of Columbia. Lenders started the foreclosure process on 20,360 U.S. properties in February, down 2%. We already know that. Those states saw a greater number of foreclosure starts in February, including, we already went over that, among 223 metropolitan statistical areas with a population of at least 200,000, those that had a greater number of foreclosure starts in February. Why are they repeating themselves? Like, this is redundancy upon redundancy. Yeah. Nationwide, 1 in every 4,500 housing units had a foreclosure filing in February. 1 out of every 4,500. That's pretty low.
Yeah,
it's pretty low. So those states are highly foreclosure rates in New Jersey, Maryland, Illinois, Nevada, Indiana, among 223 metropolitan statistical areas, population of at least 200. This is mumbo jumbo.
Yeah.
This is propaganda mumbo jumbo. JC, take it to us.
Bring it back.
Bring it back.
Bring it back.
So I think that it's a clear indicator that someone is attempting to continue to spread fear in the first-time home buyers because they don't really understand the statistics and what actually goes into the data. And when they see something like 87% increase, they're like, whoa, we're going to wait until those foreclosures hit the market. Chances are it's not going to happen.
You're not going to find it. It's probably not your city.
And that is also something that I think the listener should know, which is if a foreclosure is started, that doesn't mean that the seller still can't sell the house.
Yeah.
They have a window that they do have the ability to sell that property. And we know that there's equity in there. It's not like that house gained equity, that house gained equity. And because you have a foreclosure starting, yours went down in value.
Yeah.
That's not true, you know?
Yeah. And I think a lot of, I'm trying to think of in the last year, it's like we did all of this and there was the forbearance period where people couldn't go under foreclosure. They could just issue the forbearance. Coming into this year, it's like, what would have somebody actually go through foreclosure process? Be like a loss of job, right? Even that, if you did sell, you have all that equity, you can cash out on it, go purchase the next home if it did.
Including the fact that since all of the new regulations came into play due to COVID and the forbearance that they have, there are more ways than ever to keep your home if you want to keep it. Yep. If your goal is to keep your home, reach out to the lender and come up with a plan, because I promise you that lender doesn't want to keep your property. They're there to collect interest. They're there to adhere to the board and their stakeholders. They're not here to collect property so that they can turn around and try and sell them, including Open Door and all the others. They don't want to hold these properties. They're there to sell them, flip them, make a profit, or collect the interest on them throughout time. Yeah.
Time itself.
Time is on our side. So, I hope you guys are getting something out of this. We are going to continue to do this. We haven't missed a beat, even though it's getting difficult to fit it in as we continue to get busy with mortgage loans and educating buyers all over San Antonio and surrounding. But just as a reminder, Matthew Stansberry with I Think Mortgage is now licensed in California and in Florida.
Oh, say it again.
Kapow. Matthew Stansberry is licensed in California and Florida.
And if you need another state, just let me know. I'll do it for you.
That's awesome. Well, guys, we will catch you back here tomorrow. Don't know what time, but we will stick to it. And who knows what we're going to talk about. But it will be mortgage related, real estate related, and we'll always bring our personalities with us.
Let's go.
We'll see y'all tomorrow.